As the election approaches, one of the topics that comes up is corporate income tax rates. And we're going to talk a little bit about corporate income tax rates, some comments that Warren Buffett made about them, the implications for valuations, and also the implications of debts and deficits on the U.S. economy today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. As usual, I will be trying to answer some of your questions, but as I was going through some tweets last night, I saw some comments being made about corporate income tax rates, and I thought I might respond to some of that here and now. A common thing that we hear being said by politicians, arguably on both sides of the aisle, I think one says it more often than the other, but is the notion that taxpayers should pay their fair share. And what represents a fair share is one thing, and we can all have different opinions about that. But we also have to have some realistic sense of what's actually feasible before it ends up having really pernicious implications on either asset prices or the economy and things like that. Now, some of you may remember in an earlier presidential election when Michael Bloomberg was running, that there was a reporter who was talking about the amount that he was spending on his campaign, and reportedly he was spending something like $500 million. And I think we have a video from MSNBC that we can play about a tweet that was sent sort of thinking about the magnitude of $500 million in ad spending and the implications for the electorate. And maybe we can run that right now.
He tweeted recently that actually with the money he spent, he could have given every American $1 million.
I've got it. Let's put it up on the screen. When I read it tonight on social media, it kind of all became clear. Bloomberg spent $500 million on ads. U.S. population 327 million. Don't tell us if you're ahead of us on the math. He could have given each American $1 million and have had lunch money left over. It's an incredible way of putting it.
It's an incredible way of putting it. It's true. It's disturbing.
So, incredible is right that 500 million divided by 327 million is a million. Of course, it isn't. It's not even close to that. You could not have given everybody a cup of Starbucks. But the reason I wanted to show that was because when large numbers get thrown around, it is very easy for some people to get thrown off. And sometimes we don't really think about the math that much. And this is particularly true when we start thinking about numbers as large as those that affect the largest publicly traded companies in the world and the largest economy in the world. And when we think about debts and deficits. And I wanted to show that clip first because recently Warren Buffett was talking at the Berkshire Hathaway event about the taxes that Berkshire Hathaway pays and the fact that we may be eventually in an untenable position with respect to fiscal deficits, and that the necessary response, or a response that the government might have, would be to increase tax rates. And he was specifically referring to corporate income tax rates. And he made a statement that I think caught a lot of people's attention and actually excited a lot of people. And I think we can play that video now. It's kind of interesting. And then we're gonna take a look at what he says and whether it adds up.
And I think that higher taxes are quite likely, and the government wants to take a greater share of your income or mine or Berkshire's, they can do it. And they may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And we always hope at Berkshire to pay substantial federal income taxes. We think it's appropriate that a country that's has been as generous to our owners. It's been the place. I was lucky. Berkshire was lucky it was here. And if we send in a check like we did last year, we send in over $5 billion to the U.S. federal government. And if 800 other companies had done the same thing, no other person in the United States would have had to pay a dime of federal taxes, whether income taxes.
So I think we should probably explore that a little bit. First of all, Warren Buffett, who, like anybody, I have a tremendous amount of respect for him, but we need to delve into this comment a little bit, because if people hear a comment like that, they might come to the conclusion that the fiscal imbalances that we run in the United States could be solved somewhat easily. And unfortunately, that's not actually true. And I'm going to just unpack a couple of the things that he said first, and then we're going to talk a little bit about corporate income tax rates. But the first comment that he was making was that if there were 800 corporations in the United States that paid $5 billion in corporate income taxes, no other tax revenues would be necessary. Now, that's not correct, because the federal government, the U.S. federal government's aggregate spending, so the official spending is about $7 trillion a year. But the real spending is actually a little bit higher. It's just shy of about 7.2 trillion. And the official U.S. federal budget deficit is about $2 trillion, and the real U.S. federal budget deficit is about 2.2 trillion. And if you want to explore that a little bit more, I highly recommend the usdebtclock.org. It's a nonprofit website as far as I know, and then I remember when it first came out that it was created by the Pete Peterson Foundation. Pete Peterson, for those who don't know, he was the co-founder of Blackstone, and he left and retired much earlier, along with Steve Schwarzman. And he spent a good portion of the latter stages of his life talking about the federal budget and imbalances and how we need to resolve those. But I think it's pretty easy to see that, first of all, 800 companies paying $5 billion in taxes is $4 trillion, so that would leave us well shy of the needed revenues. But there's another more important point to me than whether or not that's the right number. It's understanding the scale and scope of government spending and deficits relative to corporate incomes, personal incomes, and so on. So it's one thing for Berkshire Hathaway to pay $5 billion in corporate income taxes. So the official U.S. federal corporate income tax rate is 21%. If my memory serves me, the most recent recommendation coming from Kamala Harris is to increase that to 28%. Okay, whether that's the appropriate number or not, we can get to that in a second. But Berkshire is the 7th largest publicly traded corporation. Obviously, we know there's only a handful that are in the $1 trillion club. And there are not 800 companies that could afford to pay $5 billion in corporate income taxes. In fact, if you take the entire Russell 1000, which essentially comprises the 1,000 largest publicly traded companies in the United States, the aggregate corporate income, net of taxes for those companies in 2023 was about $2 trillion, which is less than the U.S. federal budget deficit. So effectively, if you had a confiscation of all corporate income taxes in the Russell 1000, you still wouldn't cover it. And the reason I bring this up is because as we think about policy, we need to understand the scale and scope of the problem. As it turns out, government spending in the United States represents close to 40% of GDP. I think the actual number is about 38.9. At least that's what I was saying. I think I got that one from Fred, the St. Louis Federal Reserve Bank, which reports a lot of statistics on this. And I bring all of this up because when we think about the people we elect and the policies they might enact, and the solutions that they're proposing, these are the kinds of things we ought to be thinking about. Now, I've previously stated if the U.S. federal corporate income tax rate is about 21%, the effective rate is closer to 16%. And, we can expect some form of offset. So if it goes up to 28, that's a 7% increase. Is all of that going to end up coming out of corporate income taxes exactly? Probably not. But it does sort of lend some perspective that if the remaining, if there's $2 trillion in Russell 1000 net income, net of taxes now, even increasing from 21% to 28%, is only going to be 7% of $2 trillion, or about $140 billion, less than 10% of the U.S. federal budget deficit. Okay, so let's just talk very quickly also about the U.S. federal budget deficit and what its implications are for GDP. Now, most of you who have watched this in the past know that I like to talk in round numbers because it's just easier for us to conceptualize. Our economy is, in round numbers, it's slightly less, but let's just call it 30 trillion. And the U.S. federal budget deficit, as I indicated, was about 2.2 trillion. So how much does that deficit spending actually contribute to GDP? Well, that depends a little bit on the multiplier effect. The multiplier effect in terms of real GDP is higher when the economy is weaker and unemployment is higher. Now, why would that be? So you can imagine that during the Depression, FDR steps in and he starts doing all kinds of things with the federal government, hiring people and so on, and you can actually spur some real growth in the economy. If you are starting with an economy that is already at full employment, though, and you start injecting money, you can't necessarily increase meaningfully production necessarily. So instead what ends up happening is you can create inflationary effects. We are very close to full employment at this point. So we could assume a multiplier of 1 or maybe even slightly less than 1. But the net effect of it is that the deficit spending, therefore, is probably contributing somewhere between, we'll call it $1 and $2 trillion to the U.S. economy. And so that means that you're getting, an artificial bump of 3% plus to U.S. GDP. And what's alarming about that is that is essentially all of our nominal GDP growth year over year. So when one is sort of taking the temperature of people who are observing the economy and the response is that it doesn't feel good, this could potentially be one of the reasons. Okay, so the other thing I would just quickly add in all of this is that if corporate income taxes go up, then the natural corollary to that is that corporate income available to shareholders, that would be us investors, will necessarily go down. And the next question, therefore, would be what happens to share prices? Well, presumably, if the E goes down and the PE does not go up, then share prices must similarly fall. Now, I've been giving this some thought, and all of you can give some thought to this as well, what the implications would be. One way to think about it is perhaps you would get a higher multiple because investors would recognize that income taxes, corporate income taxes, could actually decline, and that's a potential future benefit that other, political leaders, if they decided to lower corporate income taxes, could unlock. There is a flip side to this, though, and that is that if we take a look at some societies where things have kind of come undone, oftentimes when you have sort of populist groundswells and there's this attitude that you're going to soak some other participant, that it actually ends up building on itself. So bad policy leads to more bad policy, and so on and so forth. Now, with that in mind, I wanted to just share my screen really quickly before we move on to some of your questions. And this has to do with why something like that might happen. Why would it be that the electorate would support politicians whose policies, which could, be confiscating some assets? Why would that happen? Well, one of the reasons for this is that if we move increasingly towards the determination about these policies being made simply by simple majorities rather than sound economic policy, it becomes increasingly easy for a majority of the people to try to vote for policies that would enrich them at the expense of some minority class. And so on my screen right now is a chart of the incomes by group. So we have over here on the left, the bottom 50%. So this is the percentage. They get 10% of the income or thereabouts for the bottom half of, and this is just personal income taxes. And in orange is how much of the income taxes they actually pay, and so on and so forth. So this is not equal-sized buckets. The leftmost set of columns is the bottom half of the population, and the rightmost set of columns is the top 1%. So we can see that the top 1% are getting more than 25% of all income collected. They're paying more than 45% of all income taxes collected. But they alone, that 1% group, are taking in more than the bottom half combined. Now, the issue that you end up having in a situation like this is that, and you can see that our tax system is progressive. Is it progressive enough? Well, that's a question that I'll allow each of you to try to answer on your own. But the point I'm trying to make is that when you have a progressive tax system, one of the things that can happen is that there is just an increasing desire to get more of that portion of the income or the assets that you do not possess. And because it's a small percentage that control most of that and a large percentage who do not, you can see how it can lead to a series of confiscations that aren't necessarily helpful in the long run. And to illustrate that, I wanted to also think a little bit about the nation's wealth, which is all of the real estate, all of the corporations, everything essentially that is here. When we value those things, including the publicly traded equity markets, private too, the value of those assets declines as the income that they produce declines. So you, in a very real sense, you can get into a little bit of a spiral where you begin to confiscate increasing amounts of the production and income of a certain segment, and the value of that declines precipitously, and it can turn out rather badly. So it is also fair to say that when the electorate is looking at the debt and the deficits, one of the reasons that 50% of the population may not be excessively concerned about it is because they are net beneficiaries. They are not actually paying the debt. The bottom half of the country pays only 2.5% of the income taxes. So in a real sense, when $1 trillion worth of debt is being incurred, they're really only on the hook for about 2.5% of that, or about $25 billion. And on balance, they're going to be net recipients of benefits. Now, I believe that should be true. I think that it is 100% appropriate that we should have some social safety net. But I also believe that it's true that when the electorate is not connected to the consequences of the debt that are incurred by the country, that kind of perverse incentives means that they may not worry about it at all. And I have a feeling that that's kind of what's happening here. That plus the large numbers, essentially meaning that people are numerically illiterate, innumerate, as they sometimes say, and that could be contributing to these problems. So I just wanted to throw that out there. And I also wanted to throw out that if we take a look at, if we make our corporate income tax structure too onerous, that U.S. companies end up with a material disadvantage to other countries. And that could include Ireland, which completely redid their corporate income tax structure. That encouraged a lot of companies. Some may remember the conglomerate Tyco relocated to Ireland. The UK, actually, if we went up to 28%, I think the UK would have more favorable corporate income tax structures than we do. Estonia, Switzerland, there's a number of countries, Ireland, of course, being the most notable because I think their top bracket is something like corporate income tax is something like 12%. Estonia only taxes, I believe, distributions to shareholders and not retained earnings, which in turn can encourage reinvestment in the business. I'm not saying that's the right answer either, but I just wanted to throw it out there. Okay, so with that, I will go and start taking some of your questions. Michael Kane asks, "Hi Mike, do you have a suggestion on an options trade to go long NVIDIA with a 4 to 6 month time horizon?" So, I think I pointed out on the last live stream that how much you pay for an asset affects essentially the risk that you're taking, and that we are at a point now, and here we are lingering around all-time highs in the S&P, that we have seen periods of higher valuations, but we are certainly above average now. So your belief should be either that corporate earnings are going to grow much faster than they have historically. And there's, if we resume to the mean, that's a possibility because, as I've said, over the last 35 years or so, let's just say that S&P earnings increased by about 6.5% per year on average. The last couple of years, I don't think they've grown quite that quickly. So overall, it's possible that you could see some earnings growth acceleration. I would just throw out, though, we are at full employment, and it's kind of hard for me to see how that would really expand much from here. But I mentioned that because I had proposed potentially hedging a portfolio. So that's one of the things you could do, is you could buy NVIDIA and add it to your portfolio and then hedge your portfolio with Q put spreads or SPX put spreads, NDX put spreads, SPY put spreads, something like that. So a general market hedge, and you would get some hedging benefit from that because presumably NVIDIA would not be your only holding. And it's a meaningful percentage of these indices, right? So if it goes down, we would expect to see that. So I'm just taking a quick peek. It's almost 7% of SPY if you were using that. It is, we'll take a look at the Qs in case you were using that, or NDX. It is 8.3% of that. So if that was representative of how much you had in it in your portfolio, that would work. Okay, so as an alternative to that, though, you can also hedge by simply buying calls in the stock itself, and then doing some things like arguably selling some near dated premium against it. Now, again, if you did not join us for the prior live stream, one of the things I was pointing out is that many stocks, the market overall, but many stocks also, have inverted term structures. What an inverted term structure means, simply that near dated options are trading at, in implied volatility terms, a premium to the longer dated ones. Usually this is a function of what we call event variance. That is to say that the options market is expecting volatility as a result of some upcoming catalyst, and for almost every single stock that's going to be reporting earnings, which we're sort of in full swing now, entering into earnings season, and the election, that's going to be the case. So it is true also for NVIDIA. Right now, the November 22nd expiration has about a 54% implied volatility, and if we go out to June, it's about 50. So that's one of the things that you could do, is look to put on one of these diagonal calendars that we talk about when you have that kind of a dynamic. Number one, to help offset some of the premium that you're spending, because near-dated options decay more rapidly than longer-dated ones, all else equal, as a percentage of their own value. The other being that you think that the upside that you're betting on could have some limits. Let me just scroll this over, because so right now we're at about 132. So perhaps you could, buy something like the 132 calls that are at the money, 132, 134. We'll just pick any one of these going out in time, and then sell something near dated against it. Remember, it was the Novembers that I was saying were highest. We have a resistance level up here, at least by options plays work, of about 140.75. But maybe we'll pick something a little bit higher than that. But this would be an example of a trade one could do. And you end up with a structure like this, which is kind of what is also sometimes referred to as a poor man's covered call. Now, in NVIDIA's case, it's very likely that it's going to move around quite sharply on earnings. And that is the week that they're expected to report, and it's obviously the week that the options market is implying that they will. Typically moves about 8%. So another possibility would be to give yourself a little bit more of an upside buffer if you chose. But I think that's a decent setup, and I have been recommending it in a number of stocks just because that just happens to be what the market is giving us at the moment. Okay, next. Any thoughts on a rolling SPX Iron Condor trade? 200 plus points up and 200 plus points down. For example, sell the 5850, 5900 calls, sell the 5500, 5450 put spread each week with 7 days to expiration. Well, first of all, you are also trying to capitalize. And actually, I'm going to do this because I'm going to create that exact same trade, but I'm just going to do it with SPY instead so everybody can sort of see what we're talking about. So an Iron Condor is a trade where one sells a downside put spread, sells an upside call spread, same expiration, typically is the way that would work. And the idea is to collect some form of income. And this is a strategy that, well, generally we like it. In most cases, through time, this was a little bit less true over the course of the last year or so. But one of the things we've seen is that index options have, and by association, of course, that would mean the ETFs that track them as well. So SPX, if SPX options are overpriced, then expect SPY options to be overpriced, IBV options to be overpriced, and so on. And similarly, if they're underpriced. But so a condor is, the Iron Condor, which is what he's talking about. But if you do the call condor or a put condor or an Iron Condor, the payoffs of all of those are going to be very similar. I prefer what you're doing using SPX because it settles to cash, which eliminates assignment risk, which will be the case for what I'm going to do here, which is I'm going to do this. Okay, I'm going to construct this now for SPY so we can sort of see, but I want everybody to get a sense of it. So you're saying go out 7 days. I'm just going to go out until the end of next week so we can get a sense of this and see what this looks like. You were looking at the 58.50, so that for on the call side, we're just going to go 5.85 and 5.90. Now bear in mind that the forward doesn't line up exactly, so these strikes may be a little bit off, but so 5.50, 5.45. Okay. So selling the call spread, selling the put spread, and here's what you get. Strategy that looks a bit like this. And we should probably bump those strikes up because you're trying to go actually pretty much in the middle. So I'm going to just manipulate these strikes slightly. Take these up a little. And I'll take these ones up as well, just so we get it a little bit more symmetrical, which I think was your intent. There we go. Okay. So for everybody who's looking at this, this is the structure that you would be talking about. Now, whenever you sell a vertical spread, the most that vertical spread can be worth is the distance between the strikes. So if you sell an upside call spread and you sell a downside put spread, and they're both the same distance apart, then the most, so in the SPX case, the most that trade could be worth is $50. That's the difference between the strikes. This is only 5 because SPY is about a tenth the size. And the premium you're going to collect, and this was a mid-market assumption that we're making here, is about 60 cents. So the good news is about a trade like this that the probability that you get to keep that money is quite good, because the market needs to move quite sharply for it to violate either of your short strikes. That's the good news. The bad news is that the amount that you are going to make in terms of profits is overshadowed quite significantly by the maximum risk. Now, you're making 60 cents essentially to risk $4.40. So how do we actually estimate the probability that this is going to end up in the money, or the probability that you would lose all of it? And a simple way to do this is to take a look at the delta of all of these options, which I'm going to just do very quickly here so we can see that. All right. So for these strikes that I've chosen, which I think are kind of in alignment with yours, maybe we would bump these up a little bit. But the probability of it going above 590 is about 12%. And you're collecting 60 cents, so you're not going to lose until it goes above 590.60. And the chances that it's going to go below the lower short strike of 555 is about 7%. And the thing is, one thing about an Iron Condor that I think I should point out is that at expiration, the stock can only be in one place. It's either going to be lower, essentially unchanged, or higher. So the risk, one of the reasons that Iron Condors are sometimes more appealing ways to play a range-bound strategy than simply selling the upside call spread or downside put spread is because you're going to collect more premium, and the total amount of risk you're taking is still the distance between the strikes. But obviously, much can happen. So in general, I rather like it. I will say that, remember this from the 2016 presidential election, that we had huge volatility when Trump won. It kind of surprised the market. I don't think kind of. I think it materially surprised the market. The futures sold off overnight as those results were coming out, and then quickly reversed. And then the market just shot higher, as a lot of investors viewed that to be generally good for equities. So I would urge in the same way that I urge caution, getting short premium going into catalysts for single stocks such as earnings, because some research has shown that that's not necessarily a great strategy. 40% of the volatility or thereabouts that equity is going to experience over the course of a year probably comes in and around earnings. So overall for the market, the election is going to present a similar kind of spike. PC says, thank you for your research on a list of stocks that have shareholder-friendly management buying back shares. Oh, yeah, you're very welcome. Happy to do it, and we'll look at some more of those for next week, I think. How do you usually manage the losing long leg of the strangle swap, which is usually 3 months out for next earnings events? Thank you. Yeah. So that's a good point. Very often when the strangle swap trades are profitable. So let's just take a quick peek. And this isn't going to be a recommendation. It's going to be an example. Let's take a look at some upcoming earnings and construct one of these trades and give some thought to what one might do. Okay, so we've got today is the 9th. Probably don't want to look at Delta because that one is going to be... Let's look at United. They're not reporting until next week. Okay, so we're going to look at United Airlines reporting on the 15th. United's average earnings move is about 5.5%. So if we were going to do a strangle swap on this, and our expectation was for a 5% move, stock is trading $60. That's 3% this way or that. So we can just modify this, and we're going to go out and capture their next earnings, which is late January. That's going to be a little... I don't know... that January is going to capture it. So I'm going to use March in our example. Stock's trading $59.50. We'll go up to, we'll pick 62.5, and we'll go down on the put side. Oops, that should be a call. Sorry. And on the put side, we'll take it down also to, we could probably just use 55. And then we're going to buy those options, and then we're going to sell the nearer dated options against it. So I'm just going to put 2 sells in, and we're just going to go to October regular. This is for simplicity. Doesn't have to be this way, but you'll get the point. Long the 62.5, short the 55s. So for those who are interested in strangle swaps, this is kind of what that trade looks like. Okay, so we've identified that there's an upcoming catalyst. We recognize that the stock could and very likely will move. We're buying longer dated options. We're trying to sell the overdated, short dated premium and capture the vol crush for the shorter dated options that are going to decay. And you get a profile that looks a little bit like this. Okay, so this has about a 70% probability of profit, at least by this calculation. And they are, if you do them symmetrically like this, generally going to make more money if the stock runs to the higher strike than the lower one. So let's imagine, in answer to this question, that that's exactly what happens. So United reports earnings next week. It's trading 59.5 right now. And let's say it all works out perfectly. What would perfect be? Well, we want it to run to the call strike. That's the highest point of profitability, 62.5. What is going to happen on the downside? Well, the downside is that the October 55 puts are going to go out worthless. They're going to expire next week. And of course, the March 55 puts are also going to decline significantly in value. So what then? So generally speaking, when this happens, if it does that, I am only looking out to that expiration for my potential payoff. You can close it right then and there. If you decide to keep your position open, though, what you very likely would want to do is close the downside put, keep the long call option, and work that into a diagonal, right? So now you're long the 62.5 calls. The stock's trading 62.5. You could sell the November 65s, for example, against it. And, so I'm just going to quickly modify this. So this is the position that you have right now. We're imagining that the stock went up. So you are going to, at that point, these are just going to go away. So we're going to kill those. Kill that and that, because those are going to essentially expire worthless or close to worthless. But this put right here is now going to have declined significantly in value. You don't need that put anymore, because remember, you essentially had 2 calendar trades on. So now if you have a a bullish posture, you don't need that unless you initiate a whole nother strangle swap by now, say, selling November against it. And by the way, if you did that, you would probably adjust the strikes, right? So that you're sort of centered around where the stock is. But if you don't do that and you keep hold of the March 62.5s on the long side, you would cover these, sell the March 55s. You're going to take a loss on those, but you've made money elsewhere, so it should all be good. And then you could put a diagonal on by, say, selling the 65s. Now, these 65s are not going to be, they're going to be higher than this because the stock is going to have also rallied. Vol will have come in, but the stock will be higher in that hypothetical scenario. So that's how I would do it, and that's typically how we did those trades. You don't just, you can adjust the strikes. And so we often did that. Actually, I will actually throw out one other thing, which is that there were instances when we put on strangle swaps going into an earnings, but we put it on, a week or more ahead of time, and the stock started to drift towards one strike or the other. And we kind of wanted to have a reset so that we still had the move, the average move or the implied move around spot. And so we would adjust all the strikes to sort of get things back in alignment. So there's something to think about there. Bob, basic question, perhaps silly. What's the difference between trading SPY and SPX versus the futures options? Is one more volatile versus the other? So the answer is no, it's not. So some of the reasons why I've made this, the biggest difference is going to be, first of all, the contract size. SPX options contracts are 10 times the size of the SPY contracts. And if you're trading E-mini futures, which many do. So one of the reasons why a lot of people don't trade the futures options is very likely just simply because they're not looking at them. They don't trade futures that frequently, and consequently they're just not thinking about it. People get into a habit. I have former colleagues who traded SPY as a market proxy and still do it, and it's just the way they think about things. They even think about the market in terms of the level of SPY. I think about it in terms of the S&P 500 or the SPX index typically, but everybody has their own sort of preference on that. But the volatility of these things is all going to be related to one another. If it was not, you would have an arbitrage opportunity, right? Because they're all based on essentially the same underlying index, so their behavior should be the same. If one became mispriced relative to the other, you would buy the underpriced one and sell the overpriced one, and hedge, and you should come out ahead. So, the other reason why people might elect to choose one versus the other, I guess I'm not actually, there's the tax treatment for SPY and SPX should be the same. Mixed straddles rules apply in both cases. So that wouldn't necessarily be a big reason why one would trade one versus the other. So size of contract, but the volatility is going to be the same. I wouldn't think or worry too much about it. Like I said, I tend to like SPX. I like cash settled. It's the biggest notional contract. But the advantage of potentially trading some of these other things is that you also have hours, trading hours. That would be a good reason, right? So there can be mild differences there. Okay. So short TLT trade working. Thanks. We'll try to keep it going for the next 11 months. Well. Always hate to get nailed down for quite that long, right? It's hard to say. A lot can happen, and we've got a lot that is happening, and not just the election. We have a lot of tumult in the Mideast, and that can cause some volatility for oil prices and other things. So we will see. I will say that if you start to see some material weakening in the economy and future inflation data starts to go down even further, and the economy starts softening, those would all be reasons why TLT could potentially find its footing. And so I'll just make the point that if you don't want to be in that trade, I guess, if you think that rates are going to start coming down. So if rates are going down, then TLT is going up, then that could invert, make that trade less attractive. Okay, and Corey has a follow-up. Why don't we have a flat tax on all money spent on goods and services? All money spent on goods and services. So sort of a national sales tax, if that's what you're thinking about, or a VAT tax, right? So that's has been proposed and it has been implemented elsewhere. The downside to a VAT tax, of course, is that it tends to build on itself. So, the cost of some goods can go up meaningfully, and it can be very clunky. It has, look, we use sales taxes at the state and local level quite, in many instances. Most places have them. VAT taxes are common in Europe, so value-added taxes certainly are a possibility. I have to say, I don't object entirely to, the way we tax right now. I think we could do a lot to improve it, and I realize this is sort of a separate conversation, and everybody's going to have sort of a different opinion about these things. I think that the concepts of progressive taxation in terms of income, one way that it might be handled without implementing a wealth tax, which in places where it has been tried, haven't worked out all that well in many instances, would be to tier the rates of progressive. This is just, I'm speaking off the cuff here, so this isn't a completely well vetted tax plan, but one can imagine that you could create a set of incentives that would deal with some of the things that we don't contend with now. Give you an example. Someone is 25 years old. They graduate from graduate school. They're $250,000 in debt. They have a negative net worth. If their net worth was hitched to their income tax bracket, so rather than just taking a look at their income, you actually took a look at their income and their net worth, it would be a way, without incorporating the bureaucracy of transfer payments to accommodate handling the debt burden, I think that would be a way that one could think about resolving it. And I haven't really heard anybody discuss that. A wealth tax by itself, that kind of direct taxation, is likely unconstitutional anyway. But it is not clear to me that doing it, and one of the advantages of this would be that you could eliminate some sort of things that aren't quite right. So, for example, housing costs for those that live in very expensive cities like New York, and where most people are renters, they don't get the benefit of being able to write off their mortgage interest and the property taxes, something that the owners would. This would be a way, essentially, to help deal with some of those imbalances. It's not, and like I said, this is not a vetted tax plan, but it is another way to think about how you tier progressive taxation in a way that might be fairer to people who don't have much by way of assets. And that actually is one of the curious things that happens, is that if we print a lot of money, those with significant assets are naturally hedged because they own assets, not money. For those that are working and live paycheck to paycheck, inflation is much more damaging. And so coming up with something that is hitched to their net worth in this way would help even out some of the unfairness that inflationary effects can have on lower incomes. Just something to think about. And it also happens to contend with things that are outside of the control that we can't really tax. This unrealized gains, for example, that's untenable, and it's also not entirely fair. And I have a feeling that if you proposed ways to think about that to even those that are proponents of it, they might come around a different way. I have some examples of that, but let me just get to some of these other things first so that I'm not going to take up all of that, just my random thoughts about tax policy. PC says, intrigued by your discussion on synthetic stock, consider a strategy where you buy a 50 delta call spanning earnings and selling a 30 to 45 day out 30 delta put. So a risk reversal. That's what that is. And you can also stretch that out in the calendar as well. Okay? And, oh yeah, and you have a second part here. And strategically sell upside calls not spanning earnings if appropriate. So a call spread risk reversal. Diagonal. Yeah, I like that trade. And actually, I think it's, yeah, that is a trade that I do like. And particularly what you mentioned, which is avoiding selling those upside calls going into something like earnings. I think that makes a great deal of sense. Okay. Debt to GDP picked to about 200 now, and it's higher than it was before the 2000 crash. So yeah, the debt to GDP ratio, okay, it depends a little bit how you think about debt. So right now, let's just say that the U.S., the recognized debt is about $36 trillion on a $30 trillion economy. So that's actually like 120% of GDP, not over 200. Over 200 is where Japan is. And there is a point at which it's not sustainable. Or at least it's going to have really negative impacts on things like growth. Now, just think about this. Governments represent about 40% of the economy as it stands right now. And do you want that to be a larger number or a smaller number? Everybody's going to have different opinions on that. 100% of it is communism, right? So, and zero is, I don't know, somewhere between pure libertarianism and anarchy, something like that. I don't know. I think the bulk of us probably live somewhere in the middle. I would suspect that in terms of percentages of GDP, we probably don't want to expand it much beyond where we are right now. I think we could make it much more efficient. And as an example of that, I want you to just think about this, and that is HUD, for example. That's just one department inside the federal government, Housing and Urban Development. And Housing and Urban Development, which is supposed to be essentially the administrator for housing policy in the United States, their budget is equivalent to the revenues of the two largest home builders in the country combined, D.R. Horton and Lennar. Where does it all go? And I'm not going to say that they're not doing good work. They may very well be. But the chances that government money are being spent efficiently to deliver the goods and services that we hope that they would, or make sure that people have those things, the chances are very, very slim because they don't have a natural culling action that makes them more efficient. So I think we can kind of live in this space, but make things a lot more efficient. That's my suspicion. Alex V says debt to GDP indicator picked up to about 200 now, and it was higher before the crash. Yeah, so I think it was a little bit lower. It's a little bit lower than that. But our unfunded liabilities, so that's Social Security and Medicare, are substantially higher, and that's coming on. We're going to be hitting that any minute. PC, in the option strategy that was for comparison, I was also managing options, replacing calls and puts when appropriate. Yeah, makes good sense. Corey Henderson, regarding the short TLT opening and closing, taking profits. Yeah, so I think that pretty much, unfortunately, I don't have, I know the last couple of live streams I've gone well over an hour, maybe an hour and 15 or thereabouts, and here I sort of talked about things. Here we are. Mike, CNBC is on. Aren't you going to miss your segment, Sam? Yes, I am going to miss my segment. So with that, I'm going to have to wrap this up. I'm going to be talking a little bit about the call buying that we saw in some of the Chinese stocks today. Those stocks got hard hit. People are talking about government intervention there and thinking that it's not going to do all the things that they hoped it would. But it seems like some people are taking advantage of the lower prices that we're seeing today to buy some upside calls in those places, and that was some of the flow that we saw. So hope you guys tune in again for the next one. The regularly scheduled one is going to be next Monday, 4:15, but we may do one prior, especially if you guys throw into the regular comments, because we're not going to have the live stream comments. But if you want to get into a more in-depth conversation on some of these policy issues, I'm happy to talk about it, long-winded though I may be. Thanks for watching.